Hello, everybody. This is Toni Turner, and welcome to the market now as of lucky Friday the 13th at about 1:45 p.m. Eastern. Well, global stocks advanced today for a sixth straight session as investors assessed the start of the U.S. fourth quarter earnings season. On Wall Street, U.S. stocks headed down slightly after earnings reports from several large banks such as J.P. Morgan Chase, Wells Fargo, Bank of America, and Citigroup all edged lower. So now let's go on and look at three charts that might give us some insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. Of course, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, why do we bother to keep up with knowing where the SPY is, or the S&P 500? It's because when the S&P 500 heads lower, or let me start with this. When the S&P 500 starts higher or is in a bull market, 3 out of 5 stocks will follow the ETF or the SPY higher. When we're in a bear market, when the S&P 500 or SPY is heading lower, 4 out of 5 stocks will follow it lower. So the S&P 500 or the SPY you can use acts as a guide of sorts, so that we can refer to that before we get into most positions. When I captured this chart today, the SPY was trading right here at $396.29. That is about 23% below the SPY's all-time closing high on January 3rd, which was at $477.55. So we're still in bear market territory, at least slightly, looking a little better than we did though. So in November and December, and we can see how the SPY here fell down, of course, down to these October lows, about 349, gapped down, started moving higher, and then walked in kind of a decent uptrend. We thought it was pretty good at the time, up above the 50-day moving average, which we always like to see. That's kind of a midterm moving average, up above the red line, the 20-day moving average, then actually went up and moved through and above the 200-day moving average, which is coming down overhead and acting as resistance. So it hopped above the 50-day right here, starting here, and then even hopped above the 200-day moving average a couple of times here, with a high up here at 410. But on this particular day in December, it gapped up, hit resistance from earlier in November, and then said, I can't do it, and fell back down below the 200-day moving average, which can act as a very powerful resistance line when it's moving lower. So it hopped up above it, then fell below it again. And you know, a lot of times I'll say, if a certain stock or a certain ETF or index, whatever it is, can have 3 consecutive closes above a resistance point, a lot of time that can kind of say, okay, maybe this can go a little higher. But in this case, at the end of November, it fell right back down. Then again, as I said, gave it a college try, bumped up, gapped up to open about 410, but could not go any higher, and so fell down, doing this, what I call a dumpster dive, back down here to support at about the 376 zone. Then as we moved into the end of the year, the S&P 500 consolidated into the end of December, then wandered around for a few days at the open of the year, and then for the last week, 10 days, it has thankfully moved back above the red line, the 20-day moving average, and we talked about we wanted above the green line, the 50-day. These are all inverted here, with the 200 being higher. What we want to see is for them to be all underneath, I should say, the in this case the pattern of the SPY, but we're still fighting it here. So today at 396.29, the SPY is fighting to get over this 200-day moving average, which is coming in today at $397.19. That's where it is right now. So this is the ceiling, this 397, where the 200-day moving average is. This is the ceiling, we'll call it, that the SPY needs to overcome so that it can get above this 200-day moving average, get over that resistance, come back up. Now I drew an uptrend, and I drew a channel line over the highs here. So this line can also act as resistance. So we need to get up here again above 407, 408, back up to this 410 line in order to get into a nice bullish market. But we will see. And I did explain to you before, we care because mostly stocks will follow the S&P 500 higher. Not all of them. A lot of biotechs go in their own direction. Many commodities stocks will go totally in their own direction, but still in all, we need to get above, stay above the 200-day moving average and get above this 410 line. So again, we're going into fourth quarter earnings season. That's going to be about the next 3 weeks. It can add more volatility to the market, so please be watchful, trade safely, and keep an eye on that 200-day moving average coming in at 397 and change. Okay, our next chart today is a daily chart of the Invesco QQQ, symbol QQQ. This is a major index in the market. It tracks the NASDAQ 100. Top holdings, of course, in the NASDAQ 100 are equities such as Apple, Amazon, Meta, Tesla, Microsoft, Alphabet, that whole group. So we know that they've had a rough time recently because higher interest rates make it very difficult, I should say, on tech stocks to move higher. So we've been having quite a time here. Now we know, and you can't see it on this chart, that the QQQ made its all-time closing high on November 19th of last year at $403.99. And since then has basically, on a large scale, moved lower, as have many of the other indexes. So today when I captured this chart, the QQQ was trading at 278, the red numbers here, $278.99. It is still 31% below its all-time closing high that I just mentioned on November 19th of last year at $403.99. So we're still in bear market territory here. Now we know that it gapped down on October 13th, as so many other stocks and indexes did. It gapped open at $255. Then it moved up, made a higher low here at 260. Now, if you go back in time to longer-term charts, you'll see that 260 is a longer-term support zone for the QQQ. So it's a good thing if it can hold above this. So then it started moving higher. The Qs did into November. Finally, the 20-day crossed above the 50-day, which is always kind of a bullish sign. We saw that the QQQ could walk along above the 50-day moving average and for a little while above the 20-day, but of course that couldn't maintain. It tried to get back up to the 200-day moving average, could not do it. Got up on December 13th to 296 and just couldn't go any higher. So then it fell back down hard, down to this zone again, 259, 260 right here at the end of December. That 260 line, that 260 level is key support for the QQQs. So now we see that going into January, it did start to rise in the last few trading days, moved again above the 20-day moving average back to the 50. So it's giving it a college try. It's trying. It's above the 50-day moving average today, again at $278.99. Now, what we have to see here is how the Qs act as we go through earnings season, as earnings are announced. We have to see what impact that has, what effect that has on the QQQs. Certainly a lot of these stocks I mentioned before have the power to move this index around quite a bit. And please know that when we say volatile in the stock market, a lot of traders think that that means all bad. It isn't necessarily all bad. Excuse me. Volatile simply means that price moves up and down in a wide range, maybe during the course of one day. So like you can see this October 13th, October 14th, wide spreads between the open and the close compared to the other days that surround it. So volatility just means the bulls and bears are duking it out, and it makes price ranges more highs and lows are farther apart. So that's what that means. So anyway, anything goes during earnings season. So please continue to use protective stops. I would advise on all your trades. Okay, let's go to our finals chart today. As you can tell, I was looking for something a little more docile to get through earnings season on. This is the daily chart of the Global X Robotics and Artificial Intelligence ETF, the BOTZ. Now this ETF has, and we've traded this before, it has 49 holdings. Top holdings include Intuitive Surgical, NVIDIA, ABB Limited, Keyence, Cognix Corporation. It's a global ETF. Now you can't see it on this chart, but it made an all-time high of $39.99 in November of 2021. Then it fell with the rest of the market during 2022, moving up and down in a gradual downtrend. Then it finally came down to this low again, October 13th. It seemed everybody had it. Gap down to open at $17.54. Then it gradually started rising again. And we could, if we wanted to, make a case for a very shallow inverse head and shoulders with the neckline being right here. We could make an argument for that. It did come back down here, but it started walking up the 20-day moving average and stayed above. What I like about it is it's orderly, and the BOTZ stayed above the 50-day moving average moving into November, came back down, sunk down a little at the end of the year with everybody else, fell under the 50-day, but only closed below the 50-day moving average for 2 closes, then gradually started up going into January. It did earlier in December right here, I want to note, try to get over the 200-day moving average, and it did that at $22.37. Then, as I said, it came down below the 50-day, but didn't stay there, marched back up, broke through the 200-day moving average, and here we are again right at this high at $22.38, a penny higher than back here. So it looks like the Global X, the BOTZ, it looks like it may have a chance to move higher here. I like the fact that it's orderly, but what we do have to remember is that most of these stocks are tech stocks that are in it, even Intuitive Surgical. It's still a technology stock. So if tech stocks, for whatever reason, roll over hard in the near future, you may want to back off or certainly put a stop in. So in the coming week, if the BOTZ can remain above the 50-day moving average, 50-day moving average is coming in here at $20.94. So in the coming week, if the BOTZ can remain above the 50-day moving average at $20.94, and for those of you who don't have a 200-day moving average on your charts, that's coming in right now at $21.67, just so you know. And that hopefully should act as support too. So if in the coming week the BOTZ can stay above the 50-day moving average at $20.94, I will add a small amount of shares to my trading portfolio with my initial stop. And I'm going to put my stop down here underneath the 50-day moving average at $20.50. Of course, you can adjust it wherever you want. The BOTZ could pull back here. I could see it going below the 200-day, but I don't want it to start below the 50-day. And the 50-day is rising, which is a positive sign. So, but please don't kid around. Please do put your stops in. Anyway, that's what I would advise. So if it can stay above the 50-day, and I'll put my stop in at $20.50. If and when it can rise above 24, and that's back here in August, if I can draw a straight line, if and when it rises above that, I will definitely add to my position. And of course, by then my stop will be a trailing stop. So you might want to keep an eye on the BOTZ in the coming week. And now finally, please know that if you'd like to become a more successful trader, please check out my trader training programs. You can choose from 10 different online trainings, like our flagship program, 7 Steps to Successful Trading. And you can take advantage of my easy-to-learn strategies in these trainings: how to swing trade successfully, how to trade the trend for profits, that's one of my favorite ones. How to read charts is great for novices, 3 winning setups. These are for short-term trades. And of course, Bottom Fish Like a Pro, which I use to spot a lot of stocks like we're looking today at the BOTZ. So start out the new year by learning how to increase your gains quickly and easily. To see all of my online trainings, you can go to the link on this screen, or easier still, just click on the orange button below. Now, please know that next week I'm headed to Aspen for my annual ski trip. So have a great week. I'll see you the following week. Keep green on your screen. I'm Toni Turner, and this is The Market Now.